This is bullish for gold because it creates more instability, creates more uncertainty. Those people that think that gold and silver is going to be the only winner, they still think we're nuts. And basically what this story is about the fundamental breakdown of society. So with the economy actually being one piece of that puzzle, what's happening in Iran is related to decades, if you will, of geopolitical strategy that's been going on. So the reason why it's bullish for gold is because it's creating more instability, which already existed for the US economy. This is just adding on to it. This is creating more inflation. But not only that, it's creating more instability in that the US is losing its influence in the Middle East. The reason why gold went from $2,000 in early 24 to $5,600 early this year is because of fragility in the US bond market. Can we really trust this bond market? Most people are buying today at $4,800 gold. I think now's the time to be waiting. Now, what is the panic button? The panic button is when people realize that their assets are going to start going down. And those assets are their stocks and bonds and their house. And when those things start going down, people are going to really push that panic button. And there's two different panic buttons. One is the actual consumer, right? The second panic button is your businesses. When a business pushes their panic button, they start laying people off. And when a consumer, they sell their stocks and bonds. And the irony of all this is that there's going to be no place to hide. I mean, the bonds are not going to be safe. The dollar's not going to be safe. The only place that can be safe is silver and gold, which I figured out a long time ago. And now more and more people are starting to figure out, but we're still a small little group. We're still the outliers. We're still the people, they're nuts. You know, those people that think that gold and silver is going to be the only winner. They still think we're nuts, but we will become kind of the spoken about. I don't know if the right terminology here, when the panic button does get pushed. And I think it'll get pushed this year.
Markets don't crash when data weakens. They crash when belief breaks. As Don Durrett points out here, the real trigger isn't declining prices, but the moment investors accept there's no safe exit, which historically accelerates selling across stocks, bonds, and housing simultaneously. What's not being said is that passive flows and retirement funds could amplify this panic far faster than in 2008, especially if layoffs begin rising into late 2026. The idea that there's nowhere to hide challenges the traditional 60-40 portfolio assumption. Next, Don Durrett discusses how geopolitical shocks could pull that panic forward faster than expected.
It could get pushed as early as, this month if this war expands too rapidly.
I find it interesting that you say that, because we look at what happened when the US first walked into Iran, and the price of gold went up and then suddenly just crashed, as I assume various central banks needed liquidity. We saw, was it Turkey that was selling? And we saw the price of gold basically go from, I don't know, $5,200, $5,300 range all the way down to, might have hit as low as $4,500.
4,100.
Now
4,100.
Was it 4,100?
Yeah.
It went down that far. Yeah.
Yeah.
Okay. So how do you think that the war in Iran is bullish for gold?
First of all, the war in Iran is not the story here. That's just what's currently happening in the world, if you will. The story's been building for decades. This story, and basically what this story is what I mentioned earlier. It's about the fundamental breakdown of society. So with the economy actually being one piece of that puzzle. So it's not just the economy. So what's happening in Iran is related to decades, if you will, of geopolitical strategy that's been going on. Iran and China are just kind of the more recent players in this, if you will, the last 20 years. But this actually started before China was even kind of becoming a superpower in the late 90s. They were kind of on the fringe of what's kind of building here in Iran. This is a very intricate, complex story that's happening in Iran today. And it's all about the United States trying to maintain its global hegemony. I mean, everybody's asking, why did we bomb Iran? Why did we bomb Iran, right? It's this, they never tell us that they're never transparent about their goals and their objectives. If you remember the first invasion of Iraq, they didn't tell us. The second invasion, they didn't tell us. They're not really clear on why they're doing these things. Is it a war in Iran? I mean, a war on terror. Why, if it's a war on terror, what the hell are we doing going into Iraq? There's no terrorists in Iraq, right? So the war in Iran is just one more kind of domino, if you will. But it's starting to become a very important domino. A lot of people call it like the Suez moment.
Gold doesn't spike on war. It spikes on liquidity stress hidden beneath it. As Don Durrett points out here, the sharp drop from roughly $5,300 to near $4,100 reveals a critical truth. Central banks and institutions sell gold during crises to raise cash, not because fundamentals weaken. This contradicts the popular "gold always rises in war" narrative, exposing how short-term price moves can mislead investors. The deeper story is structural. Decades of shifting power away from US dominance, not just a single conflict. Next, Don Durrett unravels how this long-term shift ties directly into gold's bigger macro trajectory.
So the reason why it's bullish for gold is because it's creating more instability, which already existed for the US economy. This is just adding on to it. This is creating more inflation. But not only that, it's creating more instability in that the US is losing its influence in the Middle East. And so a lot of people are calling this the Suez moment. So the Suez moment, 1956 or 57, I can't remember exactly which year, that was the year that the British Empire kind of lost its mojo, if you will. There was still 30, in the late 50s, 35% of global trade was still the pound. And the British Empire still had a lot of influence, but after the Suez Canal, they kind of just, fluttered away. That was like their last. That's when Egypt took the canal from Britain, and Britain couldn't hold it. And so this is very similar, where Iran's going to take the strait away from the U.S. and the U.S. can't hold it. But this is bullish for gold because it creates more instability, creates more uncertainty.
This isn't about inflation, it's about losing global control quietly. As Don Durrett points out here, comparing today to the 1956 Suez crisis signals a potential shift in monetary dominance, where the US could gradually lose influence just as Britain did when the pound declined from global reserve status. What's often ignored is that reserve currency transitions take years, but markets begin pricing them in early through commodities like gold. If trade flows or energy routes destabilize, capital reallocates fast. Next, Don Durrett discusses how this instability feeds directly into sustained gold demand beyond short-term headlines.
The reason why gold went from $2,000 in early 24 to $5,600 early this year is because of fragility in the US bond market. Can we really trust this bond market? Because remember, the US bonds are literally the foundation of the global economy. That's what people use. That when you talk about reserves, they hold these bonds on their balance sheet and they're supposed to be solid, right? Now, whoa, wait a minute. Are these bonds really safe? I don't know. Let's buy some gold. The reason why gold is up is for only one reason: the fragility of the U.S. bond market. It's no longer what it was 10 years ago. And most people don't realize that. This fragility in the bond market is really important, and most people are just completely ignoring it. They're pretending that, one, the deficit doesn't matter, and two, the debt that have to pay this off, the bond market, the ability of the bond market to do this, that is all stable and solid. It's not solid as rock. That's the reason gold's going up. So this is one of the difficulties with people that come into the gold and silver mining space. We are not investing here. We are speculating. And you need to really separate that. And most people come into this space with an investor viewpoint. You know, they try to put these miners into the same bucket as a mining company. Here's the problem with mining companies. Well, it's not really a problem. It's a distinction, a fact. Mining companies don't have customers. They don't. They basically have buyers, and they can sell to whoever they want to sell to. They're like, okay, who are we going to sell to this week? They don't have customers. It's a unique model. That's number one. The second thing is their valuation is based on the price of gold and silver. And so we can use that to our advantage, knowing that. And so the key to gold and silver mine stocks is you make your money when you buy, because you want to buy low, and you're not stupid about when you sell. You don't make a mistake when you sell. So buy smart, sell smart.
The real risk isn't stocks, it's the foundation beneath them starting to crack. As Don Durrett points out here, the surge in gold from $2,000 to $5,600 reflects growing doubt in US treasuries, which underpin global reserves and liquidity systems. What investors overlook is that rising deficits and weaker bond demand could force higher yields, pressuring equities and housing simultaneously. This turns gold from a hedge into a signal of systemic stress, not just inflation. On mining stocks, the distinction between speculation and investing becomes critical for risk control. Next, Don Durrett talks about timing mistakes that cost investors the biggest gains.
And most people mess up both of them. They buy tops, they buy momentum. Like most people are buying today at $4,800 gold. I think now's the time to be waiting. I think we got another correction coming. So you want to buy smart, sell smart. Avino went from 50 cents to $10. Guess what? Selling at $10 was a mistake. It was a mistake. And now it's back down to 7, and you could get back in, fine, if you do get back in. But what most people do is they probably bought at 2 or 3, and then they sold at 7, 8, 9, and they haven't gotten back in yet. They basically maybe they sold half of their upside. And now they're saying, oh, I'm all in profit. Yeah, you're all in profit, but look how much money you left behind. They weren't smart about when they sold, because Avino is still super, super cheap. It prints as a $100 stock right now.
Retail investors don't lose money by being wrong. They lose it by being early or late. As Don Durrett points out here, chasing momentum near $4,800 gold reflects classic late cycle behavior, where emotional buying replaces disciplined entry. The uncomfortable truth is that most profits are made during pullbacks, not breakouts. Yet media narratives push investors to buy strength. This creates a cycle where retail funds liquidity for smarter capital exits. If a correction hits in 2026 alongside tighter liquidity, those late entries get punished fast. Next, Don Durrett discusses why holding through volatility often beats reacting to short-term gains.
And so it's a $100 stock and you're selling at 7, 8, 9, 10. You don't even want to think about selling a Vino until it gets to 50. And I won't sell at 50. It's still now when it gets to 50, it's basically a 100 bagger off of 50 cents. You go, wait a minute, Don, you got a 100 bagger and you're not even going to sell any? You're not even going to take a little off the table? It's like, it's still not time yet. But now the key here is, okay, if I sell a Vino, it probably only has a 1 bagger left. You know, it goes from a 100 bagger to a 200 bagger. It's got a 1 bagger left on. I got to pivot that. I got to trade that one. I got a 3 bagger over here. I got to trade it. And you make a really good argument for that. But selling at $10 sometimes, just because you have profit, you don't want to sell a stock just because you have profit. That's not a reason.
Taking profit sounds safe, but it can quietly cap your biggest winners. As Don Durrett points out here, selling simply because a stock has gone up ignores the asymmetric nature of mining plays, where a 10x can still become a 100x under the right cycle conditions. The overlooked risk is opportunity cost. Exiting too early often means reallocating into weaker ideas with lower upside. In past commodity cycles, the top 10% of performers drove most returns. Investors who constantly rotate miss those exponential moves. Next, Don Durrett unravels why conviction matters more than short-term profit-taking decisions.
You have to have another 10-bagger, a better 10-bagger. The question is with Avino, did you really have a better 10-bagger somewhere else? Where are you going to put that money? Where? You tell me where. You're just flipping a coin. You're just praying. Okay, I'm gonna take that. You're making two arguments there. You're saying number one, Avino isn't a 10-bagger, and number two, I can put my money somewhere else and get a 10-bagger. And so this is where you got to sell smart. So you don't. I learned this lesson. I sold some First Majestic at, I bought it at $1, and I sold 500 shares at $20 to take so it's all profit. What I learned was that selling at $20 wasn't smart. I want my shares back. That's how I felt. It's like after I sold, I'm like, even though it went from $20 all the way back down to about $6, I don't know if it got to $5, I still wanted my shares back. And luckily I got them back because they bought Gatos. So now I have more shares than before because they bought Gatos and I own Gatos. But I always wanted those shares back. That was the lesson that I learned. I'm like, don't sell just to sell. So I never do that. I'm waiting for the top of the mountain. But now again, I talked about this earlier. It's all about belief. If you believe that we're going to the top of the mountain, let's wait till we get there.
Switching investments too often feels strategic, but often becomes disguised gambling. As Don Durrett points out here, selling without a clearly superior opportunity is essentially flipping a coin, especially in volatile sectors like mining, where timing is unpredictable. The deeper issue is behavioral. Investors underestimate how rare true multi-baggers are, especially outside strong commodity cycles. Missing one can set back returns for years, particularly if capital rotates into underperforming sectors. In past cycles like 2010 to 2011, holding winners mattered more than constant repositioning. Next, Don Durrett discusses how conviction and patience shape long-term gains in this space.
Let's see which ones. I pretty much own all of them. I have 165 stocks, you can imagine. I pretty much own all the good development stories out there, but I don't know which ones are going to be the big winners. But some of them will be. And so those are the ones. And now the other reason why I like to own so many stocks is I believe M&A is coming. And when there's an M&A deal, I want to own both of them. If you own both of them, it's a beautiful thing because you win both ways. And so, and I don't, usually the buyer is the winner here. So I don't want to, like if you own a whole bunch of developers and you don't own any producers, the producers are going to come and swallow up all your developers, and the producers are the ones that are going to benefit from that arrangement. Exploration companies, I mentioned that producers and developers are highly elastic. Guess what? Exploration companies are not. This is the reason why I say to avoid exploration in a bull market.
Owning everything feels like diversification, but it can dilute your best ideas. As Don Durrett points out here, holding 165 stocks reflects a strategy built around probability, not precision, aiming to capture upside from M&A cycles rather than picking single winners. What's rarely discussed is that over-diversification can reduce meaningful gains if capital isn't concentrated in top performers. The insight on producers benefiting most from acquisitions highlights where institutional money tends to flow first. In past cycles, consolidation phases drove major revaluations in producers. Next, Don Durrett shows why positioning ahead of M&A matters more than reacting after deals are announced.
Exploration companies are not elastic to the gold and silver price. If you have a drill story and the price of gold goes up $200 tomorrow, that company's not going to move because investors are waiting for the next drill hole. And they don't care if gold went up $200. They want another drill hole. They're not elastic. That's one of the reasons why people love exploration, because it's not elastic. It's inelastic, so it always works. A good drill story will always work. But in a bull market such as we're in, focus on the companies that are highly elastic, producers, developers.
How important is the management team? I asked one mining equity guru this, and his answer really bugged me, which was, I'm not going to say who, people will probably know it. I made a comment that a big part of these mining stocks being successful is that they have a CEO that can rally the street to actually back the stories, because dilution is so inherent in being successful at this game.
Not all gold stocks move with gold, and that's where most investors get trapped. As Don Durrett points out here, exploration companies depend more on news flow than commodity prices, meaning a $200 gold spike may do nothing without fresh drill results. This contradicts the common assumption that all mining stocks benefit equally in a bull market. The hidden risk is dilution. Companies constantly raising capital, eroding shareholder value while chasing discoveries. Smart money often rotates into producers during strong cycles for this reason. Next, Don Durrett discusses why management quality can outweigh even strong resource potential.
And his response was, well, if Rick Rule hasn't invested, then you probably shouldn't touch it. And I thought that was a very strange result, or strange answer. I completely disagree with that. How important for you is having a management team that has the ability to actually rally the street to back the story?
You're going to make 80% of your money on companies that have good management teams, at least. Management teams are absolutely crucial. Perfect example is America's Gold and Silver. The stock was a total dog until Paul Hewitt showed up. Once he showed up, it's a beautiful story. A lot of these development plays, it's very difficult to find a development play that has not only a good CEO, but a good board, and they know what the hell they're doing, and they're going to get it built. And when you find those, I love those. Those are the ones I absolutely love.
Following big-name investors blindly can be more dangerous than doing nothing. As Don Durrett points out here, relying on figures like Rick Rule ignores a key truth. Execution by management teams ultimately drives outcomes, not just early capital backing. The 80% figure highlights how leadership quality directly impacts financing, timelines, and project delivery, especially in capital-intensive sectors like mining. Investors often overlook this, focusing instead on resource size or hype narratives. A weak team can destroy value even in strong markets.